John, good to see you. Today we have 5 rules for investing after retirement. Retirees have so much to juggle. You have to have safe investments to protect your income streams, but not so safe that you risk running out of money in retirement. And that's why rule number 1 for you is watch out for inflation. And John, this was the headline yesterday, right? The consumer price index jumped to 7.9% year over year. We haven't seen numbers like that in 40 years.
Yes, yes. And, inflation is, I've said it before, it's the most insidious tax because
Mhm.
it erodes your purchasing power. Now, are we, hopefully we won't be saddled with $6 gas prices and 8% inflation year over year, but you have to realize that a historical long-term average for inflation is 3%. And so you have to put that into your planning, because if you don't, and you're too conservative, like a cash account, then you're going to be losing 30% in value over a decade.
Can you imagine? All right, let's move on to point number 2. Break your retirement into buckets. What does that mean and why is it important?
You know, Going back to the behavioral finance strategy, putting your money into buckets or giving it jobs. So a cash reserves, an emergency account, an income account, a soon bucket, whether that's 1 to 5 or a 5 to 10 year period, and then a growth bucket. It really helps from the behavioral finance area, because you can just concentrate on a certain allocation of money providing income no matter what the markets do. Your soon buckets, which is the money you're going to need sooner, you should invest that money more conservatively, so when the markets go down, you're not exposed to major market risks and distributions. And then lastly, your growth bucket, that's your long-term money. That's kind of like your old 401k money. We're trying to replicate what was always comfortable to you while you were working.
Okay, now let's move on to number 3. Remodel that 60-40 portfolio. I feel like this goes back to inflation again, right, John? Bonds paying yields right now that are below inflation,
Yeah, and a rising interest rate environment coming off
right?
historic low interest rates. So the 60-40, is the 60-40 dead? Not dead, but just like probably your old house, which, the 60-40 is an old concept, it needs a remodel. So really start to look at, whether it's alternative investments or hedged equities, equities with some downside risk protection to replace some of your bond holdings. Not all of them, but some of them.
And let's explain real quick, John, what's happening right now is that stocks and bonds are correlating, which means they're both not doing well.
Yeah, yeah. So correlation is when you say correlated, that is that two investments are moving in the same direction. As you look towards the left of that screen, you always see that bonds and stocks were on the opposite side of the
Right.
spectrum. Now they're lockstep, almost to a 1 in correlation, which means highly correlated. And that's why we've seen these 60-40 portfolios have so much volatility, more than what people are used to in the first 2 months.
hmm Number 4, one of your favorites. Don't forget about those taxes. Very important in retirement.
Yes, do not forget about taxes. Arguably the largest expense, not only in employment years, but in your retirement years. And the big misconception for retirees, they'll be in a lower tax bracket in retirement. You got to hit the pause button there. You have to remember that you have the 3 marginal tax traps of Social Security, Medicare, and required minimum distributions. And you also have to understand what we call asset location. And that's, especially if you have those joint or trust or individual brokerage accounts, certain investments can be triggering capital gains that are just unnecessary taxes you're paying every year.
All right. Point number 5, always have a plan. Why?
Yeah, well, it's quite simply put, if you have a plan, even though you might suffer a little pain, you have a higher probability of success, right? You
Mm.
have to plan for everything we talked about. You have to plan for inflation in your retirement. You have to plan, especially now, for an ever changing investment landscape. And well, you know how I feel about our government officials and the way they appreciate our tax dollars. We have a $30 trillion debt. The bill's going to be due sooner rather than later. So you better have a plan for higher tax rates.
Yes. And then you're more likely to stick with it too when you have that plan, right?
Absolutely.
It's
Absolutely.
very helpful. John, what's the best way for somebody to reach you if they want to talk through these points?
Well, they have two ways to reach us. Give us a call at the office, 858-935-6210, or go onto our website, www.gosecurus.com. Click on the contact us, and you have my schedule right there.
Perfect. All right, John, thank you.
Thank you, Erin.